When was the last time you walked into a Party City store? For decades, Party City was almost impossible to miss in America. Whether it was a birthday, graduation, Halloween, or a baby shower, millions of families knew exactly where to go. Bright aisles filled with balloons, colorful decorations, costumes, and party supplies made it feel like a place built entirely for celebration. At its peak, Party City wasn't just another retail chain. It was a $2.5 billion business empire, dominating the party supply industry across North America. But today, the story looks very different. The stores are gone. The brand has disappeared. And a company that once symbolized celebration ended with nothing left to celebrate. So how did a giant like Party City collapse? Many people assume the answer is simple. They blame the same forces that have destroyed so many traditional retailers, Amazon, Walmart, and the rise of online shopping. But that explanation only tells part of the story. Because the real cause of Party City's downfall started years earlier, with a single financial decision that quietly planted a ticking time bomb inside the company. To understand what happened, we need to go back to the beginning. The idea that started it all. Party City was founded in 1986 by an entrepreneur named Steve Mandel. Unlike many founders of large retail chains, Mandel didn't come from a massive corporate background. He wasn't a Wall Street executive or a retail industry veteran. Instead, he was simply someone who noticed a frustrating problem. At the time, organizing a party was surprisingly inconvenient. If someone wanted to host a birthday party or celebration, they had to visit multiple stores. One shop for paper plates and cups, another store for balloons, and yet another for decorations and party favors. The market was scattered and inefficient. Mandel believed there was a better way. Instead of forcing customers to run all over town, he imagined a single store where people could buy everything they needed for a party in one place. That idea became Party City. With about $125,000 in startup capital, Mandel opened the first Party City store in East Hanover, New Jersey. The store was around 4,000 square feet, relatively small compared to what the chain would eventually become. But from the moment it opened, it was clear that Mandel had tapped into something powerful. Customers loved the concept. Instead of visiting several stores, they could simply walk into Party City and find everything they needed for a celebration in one place. The business quickly gained momentum. Rapid expansion. As demand grew, Party City expanded across the United States. The company used a franchise model, allowing independent operators to open Party City locations while using the brand and business system. This helped the company grow quickly without needing massive amounts of capital. But franchising wasn't the only strategy. Party City also began acquiring smaller regional party supply chains across the country. By buying competitors and integrating them into its network, the company rapidly increased its presence. Within a few years, Party City was becoming the dominant name in the party supply industry. However, one strategic partnership would ultimately give the company an even bigger advantage. The Amscon advantage. One of Party City's most important moves was building a strong relationship with Amscon, a major manufacturer and distributor of party supplies. Amscon was one of the largest producers of party goods in the world. They manufactured everything from balloons and decorations to themed party kits and seasonal costumes. This relationship eventually evolved into something much deeper. In 2005, investment firms Berkshire Partners and Weston Presidio, which already controlled Amscon, acquired Party City through a holding company called AH Holdings Corporation. This deal created something extremely powerful in retail: vertical integration. In simple terms, Party City no longer just sold party supplies. It now manufactured them too. This gave the company several major advantages over its competitors. First, Party City could control its entire supply chain, from product design and manufacturing to the final store shelf. Second, it could produce products at much lower cost than competitors who had to buy from outside suppliers. And third, it could quickly respond to trends, producing new decorations and themes faster than most retailers. This system turned Party City into a highly efficient retail machine. And the company kept growing, becoming the king of celebrations. In 2006, Party City expanded again by acquiring Party America, a chain with dozens of stores across the western and southeastern United States. With this acquisition, Party City dramatically increased its footprint. By the early 2000s, the company had become the undisputed leader of the party supply industry. Across North America, there were hundreds of Party City stores. The brand had become synonymous with celebrations, birthday parties, Halloween costumes, graduations, baby showers. If people were planning a party, chances were they were heading to Party City. The business generated strong and reliable cash flow. Sales were steady, and the company appeared to be thriving. From the outside, Party City looked like the perfect retail success story. But behind the scenes, something was about to happen that would change the company's future forever. In 2012, a massive financial deal would reshape Party City and ultimately push it onto a path toward collapse. And it all started with something called a leveraged buyout. By the early 2000s, Party City looked unstoppable. The company had hundreds of stores across North America. It dominated the party supply industry, controlled much of its own manufacturing, and generated steady profits year after year. From the outside, it looked like the perfect retail success story. But in 2012, something happened that would quietly reshape the company's future. That year, private equity firm Thomas H. Lee Partners acquired Party City in a deal valued at around $2.7 billion. On paper, it seemed like a typical corporate acquisition. But the structure of the deal was what really mattered. It was what's known as a leveraged buyout, or LBO. At first glance, a leveraged buyout might sound like a smart financial strategy. Instead of paying the full purchase price in cash, the acquiring firm borrows a large amount of money to fund the deal. But here's the critical detail. The debt used to buy the company is usually placed on the company itself. In other words, after the deal is completed, the company being purchased becomes responsible for repaying the massive loans used to acquire it. And that's exactly what happened to Party City. Almost overnight, the company went from being a financially healthy retailer to a business carrying over $2 billion in debt. This changed everything. Before the buyout, Party City had the flexibility to reinvest its profits into improving stores, expanding its online business, lowering prices, or developing new products. After the buyout, a huge portion of its earnings had to go toward. Every quarter, millions of dollars were leaving the company just to service those loans. It was like running a race while carrying a massive weight on your back. At first, however, the pressure wasn't obvious. From the outside, Party City still appeared to be doing well. The public market debut. In 2015, Party City made another big move. The company went public. Through a highly anticipated initial public offering, or IPO, Party City began trading on the New York Stock Exchange under the ticker PRTY. Investors were excited. The company's dominant position in the party supply market made it appear like a stable, profitable retail business. At the time of the IPO, Party City had nearly 900 stores across North America. Its vertically integrated supply chain gave it advantages that most competitors couldn't match, and the brand was incredibly recognizable. Birthdays, Halloween, school events, Party City was everywhere. On paper, everything looked great. But the massive debt from the 2012 buyout was still there, quietly draining the company's resources. And that meant Party City had less flexibility than it appeared. Still, the company kept expanding. In 2013, it acquired iParty, a regional chain in New England. Then, in 2017, it purchased Party Galaxy, another party supply retailer based in Oklahoma. The strategy seemed clear: grow bigger, expand the brand, and strengthen its dominance. But the real problems weren't inside the company. They were starting to appear in the world around it. A strange problem: the helium shortage. One of the first unexpected challenges Party City faced was something few people would have predicted: helium. Throughout the 2000s and 10s, the world experienced several global helium shortages. At first, it might sound like a minor issue, but for Party City, it was a serious problem. Balloons weren't just another product on the shelf. They were one of the company's biggest traffic drivers. Customers often visited Party City specifically to buy helium balloons, especially large foil number balloons for birthdays or anniversaries. But once customers were inside the store, they rarely left with just a balloon. Many would end up buying decorations, plates, party favors, streamers, and other supplies. A simple balloon purchase could easily turn into a $40 or $50 shopping basket. But when helium supplies became unreliable, Party City couldn't guarantee balloons for customers. And that meant losing not only balloon sales but also the additional purchases that came with them. By 2019, the company was publicly blaming helium shortages for declining profits and a wave of store closures. Yet while Party City was struggling with this unusual problem, a much larger threat was building in the retail industry. The retail battlefield changes. During the same decade, the entire retail landscape was transforming. On one side, Amazon was growing into a global powerhouse. Online shopping was becoming faster, easier, and more convenient. With just a few clicks, customers could order decorations, costumes, and party supplies and have them delivered in days, or even hours. On the other side, traditional retail competitors were also evolving. Major chains like Walmart, Target, and dollar stores were expanding their party supply sections. And they were selling many of these products at extremely low prices. For customers, this created two attractive alternatives. They could buy party supplies cheaper at discount stores or more conveniently online. That left Party City stuck in a difficult position. Because of its heavy debt, the company couldn't afford to slash prices and start a price war with discount retailers. At the same time, its online store was outdated and clunky compared to Amazon's powerful e-commerce system. And the thing that had once been its biggest strength, its large physical stores, was slowly turning into its biggest weakness. Party City was entering a new era of retail competition. And the company was carrying billions of dollars of debt into the fight. But the worst crisis was still ahead. Because in 2020, something happened that brought celebrations around the world to a sudden stop. And when the parties stopped, so did Party City's business. By the end of the 2010s, Party City was already under pressure. The company was dealing with rising competition, supply issues, and billions of dollars in debt that limited its ability to adapt. Still, despite these challenges, the business was surviving. But then came a moment that no retailer could have predicted. In 2020, the world suddenly stopped celebrating. When the COVID-19 pandemic spread across the globe, everyday life changed almost overnight. Governments introduced lockdowns, large gatherings were banned, and millions of events were canceled. Graduation ceremonies disappeared. Weddings were postponed. Office parties were canceled. Birthday celebrations became small family gatherings, or were skipped entirely. For a company like Party City, this wasn't just a difficult situation. It was an existential crisis. The entire business model depended on people hosting parties and celebrations. Without those events, demand for decorations, balloons, costumes, and party supplies collapsed almost instantly. Foot traffic in stores vanished. Sales dropped sharply. And because Party City operated hundreds of large physical stores, its expenses didn't disappear just because customers stayed home. Rent still had to be paid. Employees still needed salaries. Debt payments still had to be made. While other retailers were able to pivot quickly to online sales, Party City's digital presence was relatively weak. Its website simply couldn't compete with the speed and convenience offered by e-commerce giants. The company was already struggling financially before the pandemic. Now it was fighting for survival. A short-lived recovery. When pandemic restrictions began to ease in 2021 and 2022, there was hope that Party City might recover. After all, people were eager to celebrate again. Weddings were rescheduled. Graduations returned. Families began hosting gatherings once more. But the world that Party City returned to was very different from the one it had left. A new economic problem was spreading across the United States and much of the world: inflation. Prices for everyday necessities, gas, groceries, and housing were rising rapidly. As household budgets became tighter, families started cutting back on non-essential spending. And unfortunately for Party City, elaborate party decorations often fell into that category. Throwing a big, professionally decorated party suddenly felt like a luxury rather than a necessity. Consumers began searching for cheaper alternatives. Many discovered they could buy decorations for far less money at dollar stores, discount chains, or online marketplaces. Others realized they didn't need specialized party stores at all. They could simply order decorations online and have them delivered to their homes. This shift in consumer behavior created a major problem for Party City. Because of its massive debt, the company had very little room to lower prices and compete. Discount retailers could sell party supplies extremely cheaply because they carried large volumes of everyday goods. Party City, however, specialized almost entirely in celebrations. Its costs were higher and its financial flexibility was limited. Even the company's founder, Steve Mandel, once summarized the challenge with a simple observation. If a retailer can't afford to offer competitive prices, it might struggle to survive. And that was exactly the position Party City found itself in. The collapse of the stock. As the company's financial struggles grew, investors began to lose confidence. Party City's stock price started falling dramatically. At its peak, shares had traded above $20, but over time the price collapsed. By 2022, the stock had fallen into penny stock territory, trading for only a few cents per share. The decline was staggering. Within less than a decade, Party City had gone from a thriving public company to a business that many investors believed might not survive. And in early 2023, the situation finally reached a breaking point: bankruptcy. In January 2023, Party City officially filed for Chapter 11 bankruptcy protection. For many observers, the news was not surprising. The company's market value had already collapsed by more than 96%, and it was struggling to keep up with debt payments. Chapter 11. Bankruptcy doesn't necessarily mean a company shuts down immediately. Instead, it allows a business to restructure its finances while continuing to operate. Party City's plan was to reduce its massive debt and give the company a chance to rebuild. As part of the restructuring process, lenders agreed to eliminate nearly $1 billion of the company's debt in exchange for taking control of the business. For existing shareholders, however, the outcome was devastating. Their shares became essentially worthless. Party City was also delisted from the New York Stock Exchange, marking the end of its time as a publicly traded company. In a strange twist, the stock briefly surged after the bankruptcy announcement. Some meme stock traders on online forums began buying shares, hoping for a dramatic turnaround. But the excitement didn't last long. The underlying problems facing the company were far too serious. Still, there was one final chapter left in Party City's story. Later in 2023, the company would emerge from bankruptcy with less debt and a smaller footprint. For a brief moment, it looked like the party might continue after all. But the world had already moved on, and the final collapse was closer than anyone expected. When Party City emerged from bankruptcy in late 2023, there was a small sense of optimism. The company had reduced a large portion of its debt, closed some underperforming stores, and reorganized its operations. For a moment, it seemed possible that the brand could survive. Executives promised that the company would be leaner, more efficient, and better prepared for the modern retail landscape. Across North America, hundreds of Party City stores were still operating. From Hawaii to Houston, customers could still walk into brightly colored aisles filled with balloons, decorations, and costumes. It looked like the party might continue, but the reality was far more difficult. The bankruptcy restructuring had reduced some financial pressure, but it didn't solve the deeper problems facing the company. The world had changed. Consumers had already adapted to new shopping habits. Many had grown comfortable buying party decorations online or picking up cheaper supplies from discount stores. In the years Party City spent struggling with debt and restructuring, competitors had quietly captured much of its customer base. Dollar stores expanded their party sections. Large retailers continued offering decorations at extremely low prices. Online marketplaces made it easier than ever for customers to buy themed party supplies with just a few clicks. Party City was trying to recover in a market that no longer needed it the way it once had. And the company was still losing money. The final collapse. By late 2024, it became clear that the company's recovery was not working. Sales were still weak. Costs remained high. And the company was running out of options. In December 2024, Party City made a devastating announcement. The company filed for bankruptcy again. This time, however, the situation was very different from the first filing. There would be no restructuring plan. There would be no attempt to rebuild the business. Instead, Party City announced it would shut down operations completely. All remaining stores would close. At the time, around 700 locations were still operating across the United States. Every single one of them would be liquidated. The colorful stores that once symbolized celebrations were suddenly filled with "everything must go" signs. Shelves of balloons, costumes, decorations, and party supplies were sold at steep discounts as the company rushed to clear out inventory. For longtime customers, it was a strange and emotional sight. A brand that had been part of birthday parties, school events, and Halloween traditions for decades was disappearing. A hidden problem. One factor that accelerated the company's collapse involved its inventory. Lenders reviewing Party City's finances reportedly discovered something troubling. The company's inventory, costumes, balloons, plastic decorations, and other party goods was worth far less than expected. Because of this, lenders demanded that Party City set aside roughly $50 million in cash as protection. But the company simply didn't have that kind of money available. Without that cash reserve, Party City couldn't secure the financing it needed to continue operating, even temporarily. The shutdown process moved quickly. Within weeks, the company began closing stores and liquidating its remaining assets. Rumors briefly circulated that a group of investors might try to rescue the brand. One name mentioned was retail executive Mitch Modell, whose family had built the Modell's sporting goods chain. But no deal ever materialized. After nearly 4 decades, the party was officially over. What really went wrong? Looking back, many analysts point to one moment that set everything in motion: the 2012 leverage buyout. By loading the company with billions of dollars in debt, that deal fundamentally weakened Party City's ability to adapt. Over the next decade, nearly every strategic decision the company made was shaped by the pressure of that debt. Money that could have been used to modernize stores, improve online shopping, or compete on price instead went toward interest payments. When the retail environment began to change, first with online competition, then with economic shifts, and finally with the pandemic, Party City simply didn't have the financial flexibility to respond. The company wasn't destroyed by a single event. It was slowly worn down by a combination of debt, competition, and changing consumer habits. An ironic ending. By late 2025, the Party City brand had effectively disappeared. However, one part of the business did survive. Omscan, the manufacturing and wholesale division that had once supplied Party City, was sold off and continued operating under new ownership. In an ironic twist, the supplier outlived the retail giant it once supported. Meanwhile, other retailers quickly absorbed Party City's former customers. Dollar stores in particular reported noticeable increases in party supply sales after the company's closure. The demand for celebrations never disappeared. It simply moved somewhere else. The lesson. Party City's story offers a powerful lesson about business. A company can have a strong brand, loyal customers, and decades of success. But if it becomes too burdened by debt, it may lose the flexibility needed to survive in a changing world. Retail history is full of once dominant companies that seemed unstoppable until suddenly they weren't. Party City is now one of them. A company built around celebrations. That ultimately ran out of reasons to celebrate.